My name is Rebecca Sarkisian, and I am here to talk to you about the market reaction to mandated climate-related disclosures. So March 21st, 2022 was a very big day. Well, at least it was a big day for accountants, but I think that it was a pretty important day for everyone in this room, and here's why. On March 21st last year, the U.S. Securities and Exchange Commission, which oversees the stock market and publicly traded securities in the U.S., issued their highly anticipated proposal for a climate-related disclosure rule. If this rule becomes finalized, it would require disclosure of climate-related risks that are reasonably likely to have a material impact on the firm. This information would be included in the Form 10-K, which is the annual financial statement filing that all publicly traded companies in the U.S. are required to file with the SEC. My project intends to answer the question, what was the market reaction to this climate-related disclosure rule? So you're probably wondering what exactly are climate-related disclosures. And broadly speaking, this includes the impact of severe weather on the firm, as well as any climate-related risks the firm faces and what they're doing to identify and manage that risk. If the company has set a climate-related goal as well, they would also have to disclose that in the financial statements, along with what they're doing to progress towards that goal each year. But the most debated part of this rule is the disclosure of greenhouse gas emissions. There are 3 scopes of greenhouse gas emissions. Scope 1 is probably what you typically think of when you think of a company's emissions, and those are the direct emissions from the firm's activities. Scope 2 is a little bit broader, and that's the indirect emissions from the purchase of electricity, steam, heat, and cooling. Scope 3 is the broadest category, and that is all of the emissions that occur along a company's value chain. So that includes the emissions of their suppliers as well as those downstream on the value chain, so including from the usage of their products. So clearly this is probably the most controversial part of this rule because it's fairly broad disclosure that they would have to make. Anytime the SEC has a proposed rule, there is a period for the public to comment on it. You can go and read these comments on the SEC website. It's all public information. And a lot of people commented on this rule. There were over 4,400 individualized comment letters and over 11,600 submissions of 32 different form letters. As a point of comparison, a cybersecurity risk disclosure rule that was published just 2 weeks prior only received 175 comments in total. So in viewing all these comments, we can really get a grasp of what the public thinks the costs and benefits of this rule would be. So those that support this rule talk about environmental protection, investor choice, and investor protection, the standardization of climate disclosures, which is currently lacking in the US, as well as increased transparency, which is one of the broad goals of financial statements in general. Those that oppose the rule talk about how they don't think the SEC has the authority to mandate disclosures like this. They also talk about the high expected compliance costs of this rule, specifically regarding those Scope 3 emissions that are going to be difficult for companies to measure and disclose. And then unfortunately, there is a fair amount of climate science skepticism mixed in those comments as well. So because this was such a highly anticipated rule, investors had developed what they thought the potential costs and benefits of a climate disclosure rule would be. And they revised those expectations once the details of this regulation were made public on March 21st last year. And it's this revision of expectations that leads to changes in stock prices, which is what I'm studying in my project. So I combined stock price data from the University of Chicago's Center for Research in Security Prices with data from the financial statements from S&P's CompuStat database. And in merging those 2 data sets, I removed any firms that didn't match between the 2 databases. I also removed companies that were missing assets or had negative or 0 stock prices according to the database. I also removed any companies that were from outside the US. So I really wanted to focus on US laws on US companies because companies from outside the US might be subject to additional environmental rules that they would have to comply with. So I adjusted the returns to exclude the average return from the rest of the world, excluding the US. And what this does is it just helps to isolate the effect of the market reaction to this SEC proposal. So what this leaves me with is called the cumulative abnormal return, or CAR. And so I calculated this CAR for a 2-day period because this was a 490-page rule. So there was a lot of information for the market to take in and to react to. And so I wanted to study more than one day. I anticipated a overall negative average CAR due to the expected net costs of this rule. And I anticipated that this would be more negative for companies that have positive net incomes, that are larger, that have higher levels of PPE, which is property, plant, and equipment, have higher levels of debt, and have more complex operations, as well as companies and industries that historically have been harmful to the environment, such as the oil and gas industry. I did indeed find that the 2-day CAR was statistically significant. And so the average market reaction was negative 1.07%, which does not sound like a lot, but it actually correlates to a $131 million decline in equity value for the average company. So companies definitely take notice of changes like this. So I also looked at some of the cross-sectional effects, and I did find some significant findings there as well. So cross-sectional effects are how the market reaction differed for companies with different characteristics. So overall, I found that the market reaction was more negative for companies that have positive net incomes, that are larger, that have higher levels of debt, and in industries that I had predicted the regulation would be low impact for. So this last bullet point is a little bit counterintuitive, but if we look a little bit closer at the companies that had the strongest reaction to this rule, we get a little bit more insight. So the most positive reactions actually were in industries like oil and gas, steel, and metal mining, and definitely took me by surprise. But if we refer back to the idea of revised expectations, it's possible that investors thought that the cost of this regulation would actually be higher for the companies and then revise those costs downwards once they saw the details. And in contrast, in industries like retail and construction, those costs were revised upwards, particularly due to these Scope 3 emissions, because these companies have a large number of actors in their value chain. So overall, the negative stock price reaction suggests that current climate disclosures in the US are inadequate and that companies will face increased costs as a result of this heightened regulatory scrutiny, potentially needing to rearrange their operations or strategy, and then also facing increased compliance costs, particularly in disclosing those Scope 3 emissions. So we were expecting a final rule to be issued by the end of this month. Unfortunately, a couple of days ago, there was a report that came out that it might be postponed to the second half of the year. So while it might be a little bit more time until we get to see some guidance on this issue, I think that the prospect of a climate disclosure rule in the US in general, in any form, is really exciting because it really signals that climate change is important to the future of business. And so we all know that companies have a very large impact on our environment. And so this disclosure rule is really intended to increase transparency and try to quantify that impact as well, which is important not just for research, but for investors that are looking to make conscious decisions on where to put their money. So while this disclosure alone will not solve climate change, I think it's an important step in helping to combat the climate crisis. So I want to give a huge thanks to Jess Cunningham, as well as my advisor, Professor Eddie Riedel, for all of their help with this project. And thank you all for listening.
Thanks, Rebecca. I learned a great deal in a short period of time. It's really, really good. So I don't really know much about the SEC except what it stands for. Can you tell us a little bit more about the body of people that were involved in crafting this legislation, like what their education is, training, how they were selected? Just curious.
Yes, so the SEC is an independent agency. There are 5 commissioners, and so they're appointed by the president. However, no more than 3 of them can be from the same political party. So right now there are 3 Democrats and 2 Republicans, and they typically have a background in finance and law and things like that.
Research, did you come across anything about if the public accounting firms have the expertise to actually audit this information?
Yeah, so public accounting firms have been working towards making sure that their technology can handle this. in looking at the comments from all four of the big four accounting firms, they are all in support of this rule. And so they're really working towards, I think public accounting firms recognize that this is kind of the future of business. And so I think it's an exciting prospect.
I could ask you a question. As far as reading the actual document itself, did you think it to be a promising document for effective regulation or actual regulation that will have an impact on not just these companies, but actually helping the environment?
Yeah, so I mean, it will remain to be seen if there's any like actual change in what companies do. But I think that, I mean, the SECs have to comply with SEC guidance. I think that this is, if it becomes finalized in the form that it was proposed as, which I'm not sure about at this point, I think it's a very broad scope, but it's a lot of detail in that. So I think it's the most detail that we're ever going to see from these companies, and the fact that it's mandatory is something that is really important for this, because right now it's all voluntary disclosure and it's difficult to compare different companies' emissions and everything. So just getting more information, I think, is important in general.
That was fascinating. Thank you. I have a question that is going to expose my ignorance. So, is this the kind of ruling that would survive a transition in presidency? Like, it seems to me that, for example, with the train car derailment, right? We know that rules that were abandoned during the Trump administration directly would have prevented the terrible train derailment in Ohio. Is this the kind of rule that will last once Biden leaves office?
Yeah, so I would hope so. The SEC, again, it's an independent agency, so their goal is not to be political, right? Their goal is to help to increase transparency and protect the markets, and I don't want to get into all of the finance stuff on that, but I would hope that it would stand. Obviously, we've seen that they move pretty slowly. This has been a very long process, and so I would hope that any changes would hopefully not happen if there is a change in presidency.
Round of applause for Rebecca. Thank you again.